Hi, my name is Ong Boon Leong. I'm with PhillipCapital Management in Malaysia. We have here from Aberdeen Asset Management is Mr Adrew San. He's currently the investment manager with the Malaysian equities team there. Mr San has been transferred from Sydney since January 2012 but has been with the group since 2009. He was previously an equities analyst at Endeavour Equities. Mr San also carries a CFA charter. Today we're here to talk about the outlook for the Malaysian market. Mr San, what is your near-term outlook for the Malaysian economy?
First of all, thanks for having me in. If I have to sum up the current situation in the Malaysian economy and the near-term outlook, I would sum it up in one word, and that it would be challenging. So if we recap and look at where are we in terms of the current Malaysian economic climate, you would think about a variety of different factors, and obviously if you're local here, you'll be concerned with the consumer sentiment. Obviously with the recent GST implementation, that would obviously weigh onto the consumer sentiment as well. On top of that, you've got the recent oil price and general commodity price declines, which obviously has an impact on significant factors within the Malaysian economic export climate. On top of that, you've got general rising cost of doing business, whether it's wage inflation. We've seen minimum wages being pushed up 1-2 years ago, which is starting to have an effect now when you cycle through the costs on a year-on-year basis, as well as the different subsidies that are being pulled off, which obviously impacts onto the input prices of the manufacturers across the different sectors. If you look at what's happening on the ground in terms of the recent company results, let's just take, for example, the consumer sector. Obviously, with the consumer sentiments impacting on different names that's listed, top line growth has been sluggish, if not negative. And on top of that, the higher cost of doing business is actually impacting on margins and obviously profitability. Looking into the next sector, which is, for example, the plantations names. Plantation names obviously impacted by lower CPO prices as well. So again, top line is being impacted, and obviously in terms of the higher wages, margins are impacted. So it's quite similar in terms of the dynamics or the pressures that we see in terms of the consumer names. Oil and gas, in terms of our exposure in oil and gas, obviously oil price has a factor, but not in terms of just the realized price that they'll be selling the products at. In terms of our exposure, we'll be impacted through the demand for the vessels that are being leased out in one of our companies. Although, having said that, oil price has potentially a positive impact in our other exposure, in the sense that low prices drive demand for tank terminal storage, and so in our other exposure on the ONG side, we're quite positive outlook for that. But if you look at the banks, which is generally a nice overview of where what the country's environment is, obviously pressured loan growth in terms of in the sense that there's lower liquidity around, so that means that there's lower savings available for people to deposit their cash into, and hence less available funds for banks to lend their money out. And obviously in terms of the credit cycle, we're seeing we're going through a tougher patch at the moment from the recent results. Now, having said that, what is the near-term outlook? Okay, so if you again look at the different sectors, what I mentioned in terms of the drivers, to be honest, most of it will likely be there in the next 3 to 6 months, in my opinion. Obviously, with the GST implementation, that would be a temporary setback. But I think if you cycle that through, you might see a slight improvement in consumer sentiment, assuming all things equal, with the cycling of the GST. But apart from that, to be honest, unless oil price and commodity prices improve and consumer sentiment somehow improves, although to be honest, it's hard to see that because household debt, for example, is very high. So there's very little space for people to spend, to be honest. And if anything, there might be some downward pressure on the environment as well, because with the higher cost of doing business, obviously the ringgit and weakening ringgit is likely to impact on import prices as well, especially when it comes to imported products and services that local domestic businesses need to continue operations. But having said that, we're still growing at 4 to 5% GDP. Yes. So relative to many other countries, I think, especially as a net oil exporter, I think we're faring relatively better in the current context that we're in globally.
Do you have an outlook for the ringgit?
We don't, to be honest, we don't have an outlook for the ringgit, but let's say if the ringgit was to be weaker, well, the simple answer is that if the ringgit is weaker, obviously exporters would benefit more, and importers would find it more difficult to pass on the costs of their imported products. But if you think about the ringgit and what's been driving the weakness in the ringgit, you can narrow it down to two key fundamental factors. The first one is obviously the oil price weakening. We are perceived as a net exporter of oil, and unfortunately, when you're in that bucket, you're only perceived as such, and one tends to forget the resilience of the Malaysian economy and the diversified economic base that we tend to have. The second driver is obviously the prospect, potential of the Fed rate rising. Okay. With that driver, I think we have to see how and when the Fed rate rises, and we'll see how the ringgit would reset in that environment once it's known. But at the moment, a lot of uncertainty, which is not helping the prospects for the ringgit. On top of the two fundamental drivers, the third driver would be more sentimentally driven, in the sense that with the recent 1MDB saga that has spilled over into uncertainty on the political side. Now, when you have uncertainty on the political side in this kind of environment, especially the foreigners tend to invoke memories of 97, the 97 Asian financial crisis, where capital controls were imposed. Okay? So obviously that feeds into fear over holding ringgit-denominated currency, and that obviously impacts onto the weakening ringgit as well. The silver lining, I would say, is that with the Bank Governor and our Prime Minister, stating firmly that there won't be any capital controls in this type of environment. I think that if we go through this tough patch without having to resort to capital controls, then it would set a precedent that actually help offset the memories of what we did in '97. So that's the silver lining there.
Given the background that you've painted, with so many challenges, where do you see pockets of investment opportunities in Malaysia? Which sector would you overweight or underweight?
Yeah, good question. Obviously, with the stock market routes, I think that's a very pertinent question currently in this kind of environment. Although, having said that, in terms of what was announced by Prime Minister Najib last week, where he announced a 20 billion ringgit injection into value cap for the purpose of buying undervalued stocks in the index. It does throw a spanner in the works because it signals to the market, and as a result of that positive market signal, we've seen a rebound, a rather strong one in the past few days. Now, that reduces the opportunity, the window of opportunity for you to buy potentially undervalued stocks. Now, when we go through this kind of environment where things are appearing cheaper, it's very important to exercise discipline. It's very important to exercise caution. One should not jump into any kind of stock simply because it has fallen the most. And even in this kind of environment, we have to do our homework. So what investors can do is actually do your own research, look at which companies you're comfortable with, and more importantly, look at which companies you feel will be able to manage themselves through this rough patch. And just keep a radar, and just keep a handful of companies that you keep on your radar, so that you can buy on the dips. Don't bet your house on thinking where the bottom is for that specific stock. And the reason why you want to keep a radar on these handful of stocks that you feel comfortable with is you want to avoid permanent capital destruction. Permanent capital destruction. What I mean by that is there are times where a company's share price will fall and will not recover. And those are called value traps. You want to avoid value traps because there is a chance that the share price falling may reflect the new reality and the new outlook of that company. There might be structural changes. There might be, macroeconomic environments that would force them to change the strategy for whatever reason. So what you need to look for are companies that are strong enough to withstand this down cycle that we're in at the moment.
Okay. Do you have any that you like?
Well, we have big exposures, obviously, when it comes to, if I talk about the Aberdeen Islamic Malaysia Equity Fund. We had big exposures in the likes of Aon Company. We had big exposures in the likes of United Plantation. And obviously those two are operating in sectors where there are significant headwinds. When it comes to Aon companies, obviously consumer sentiment is the big headwind in this kind of environments, as is United Plantations, where CPO prices are not looking that great. But where we feel comfortable holding it through the cycle is that in the case of Aon Company, they continue to grow. They've had a strong track record with strong branding. Aon used to be called Justco. So with that presence with their presence in the Malaysian industry for at least 15-20 years now, strong brand name, and the fact that they are able to still roll out new stores and new malls in particularly the second and now the third tier cities in Malaysia. They continue to invest because of the strong balance sheet. And if you look into their earnings, more of their earnings now come from being landlord, more so than being retailers. So in this kind of environment, yes, there will be some softness in terms of their results, but it is largely defensive in the sense that they're getting most of their earnings in the form of rental, as well as on the retail side, they're operating as supermarkets, they're operating as hypermarkets, very much mass market type product offerings, which even though people will probably buy less of, they'll still need to come to
Generate more resilient type of business model.
exactly a defensive in the scheme of things. United Plantations, they can't control the CPO pricing, but what they can control, which is the cost of production, they are amongst the best, to be honest. In terms of their cost of production, they're close to about 1,000 ringgit per ton of CPO, and in terms of the yield, they're amongst the best in Malaysia as well. From memory, it's about at least 5 tons per hectare in terms of CPO production. So two core names that we're still very comfortable with this cycle.
Do you think the volatility in the market will continue much longer?
I hope so. I hope so, because for what we do and the way we invest, because we're comfortable with the companies that we're invested in, we want volatility so that we can accumulate on these names when people are trying to head for the exit goals. And it's through doing our own homework, it's through analyzing the companies from a fundamental bottom-up basis that we gain these comfort, and it allows us to take advantage of any volatilities that may arise.
What advice would you give investors who are keen in investing in Malaysia? And what kind of pitfalls do you think they should be looking out for?
Good question. So I suppose if one isn't in the Malaysian equity market, and I'm assuming it's probably if I were to hypothetically want to tell a foreigner about the Malaysian equity markets, well, obviously in terms of the FX, in terms of the recent stock market a downturn, there would be a lot of foreign investors that would take a second look at the Malaysian markets. At the same time, despite the headwinds that I've described, there are still plenty of wonderful stocks that are listed in Malaysia. Two of what I mentioned, and many more within the fund that we provide, and just to give you a flavor in terms of our portfolio characteristics, the average net profit margins are in the mid-teens, operating margins are in the mid-teens, ROE, which is the returns that our businesses that we own provide on the equity, is actually in the mid-teens as well, and strong cash flows as well, which we're able to benefit a dividend yield on average of about 3.5% on the portfolio. So these are in a nutshell strong businesses that we feel that are able to ride through this current downturn. Now, obviously in terms of pitfalls, there are some, and I think the biggest one from a foreigner's point of view is obviously the weakening ringgit and how that would evoke memories of 97 and capital controls as well. So, given that our Bank of England governor and Prime Minister has been adamant in saying no to capital controls in this current time, and the fact that we are fundamentally more resilient now than some 20 years ago in terms of the foreign reserves, in terms of growth, in terms of the source of that growth, which is more diversified now than before. I think this would be an interesting time for foreigners to have a look at the Malaysian equity market.
It's just following on from that, given the challenging time in market volatility, what would be the biggest challenge in terms of stock picking?
From a stock picker's point of view, the challenge has always been picking the right stocks, or more to the point, not picking the wrong stocks. Okay, that's always been our challenge. And even though we have a philosophy, a process which has been tried and tested for 20 plus, almost 30 years of bull and bear conditions, not just in Malaysia but around the world, we may not get it right all the time, just as FC Barcelona won't win all the matches all the time. But what gives us the ability to be right more of the times than not is our team-based process as well. So in terms of the process we undertake, we obviously look at the quality of the company first, in terms of having strong balance sheet, in terms of having trustworthy and capable management, in terms of having a company that's operating in an industry that is not going to fall off the cliff anytime soon, and is also operating with a strong position within that industry, and in terms of having a company that is simple for us to understand. When we look at companies with these factors, and when we determine whether they are of a reasonable valuation or not, I think these two gates help filter out the good qualities from the not so good quality companies, and obviously that would improve our chances of picking the right stocks. And the team approach is very important, because it won't just be myself looking at a specific company or covering a specific company. It will be, in this case in Malaysia, a team of 5 people, having obviously different views, different angles, different experiences, which would enrich our analysis of the specific company. And when we make decisions to invest in a company, it's not a decision that we make like it has a rigorous discussion between us 5, and not just between us 5, but in a wider group with several of our colleagues within the region, namely in Singapore, which is our headquarters. So when we go through such rigorous discussions, it lowers the chances of us picking the wrong stocks.
Ladies and gentlemen, that's Mr. Adrew San of Aberdeen Asset Management. That'll be all for today. Thank you.